Welcome to The Explainer. Today, we're unpacking a true heavyweight, the ICICI Prudential Large Cap Fund. With an incredible track record of compounding wealth over the last 17 years, we're going to decode exactly how this specific fund acts as a vital portfolio anchor amidst the upcoming 2026 market transition. So, with the market finally stepping out of this multi-year macroeconomic hibernation, global uncertainties have really restricted any clear market direction. The real question you have to ask yourself is, when these waters inevitably get choppy, is your portfolio built to withstand the waves, or is it going to capsize? Here's our roadmap for today. We'll quickly hit the 2026 market context, break down the anatomy of the fund, decode the key risk metrics, compare it against its peers and benchmarks, and finally wrap up with some long-term wealth planning. Let's dive right in. Section 1. The 2026 market context. Stepping out of hibernation. The fund house officially describes the 2026 market as stepping out of hibernation. Basically, we're transitioning from a sluggish phase driven by foreign outflows and trade tariffs into a phase of renewed fundamental awakening. But here's the catch. That awakening, while largely positive, brings its own set of rapid, unpredictable shifts. Navigating this recent market volatility requires a sturdy anchor for your portfolio. You absolutely need something that can absorb the shocks of a transitioning global economy. Moving to Section 2, Anatomy of the Fund, the strategy. The managers here used what's called a barbell strategy, and it's brilliant. On one side of the barbell, they heavily weight high-quality, steady compounders. On the other side, they balance it out with attractively valued companies. They deliberately avoid those middle-of-the-road growth at a reasonable price stocks, strictly targeting the top 100 large caps. And here's a data point that genuinely blew my mind. They maintain an incredibly low 18% turnover ratio. Given that the category average is over 80%, this signals massive conviction and true buy-and-hold patience. To actually mitigate risk for conservative investors, their market cap and sector distribution heavily favors stable giants. Financial services make up over 31% of the portfolio, while industrials sit at nearly 12%. This heavy allocation to domestic manufacturing, infrastructure, and top-tier banking is a high-conviction bet. It's designed specifically to anchor the fund during periods of extreme volatility. All right, Section 3, Decoding the Risk Metrics, built for beginners. You probably already know that beta measures a fund's sensitivity to market swings. Rather than riding the full gut-wrenching volatility of the broader market, we're actively looking for a beta under 1.00. That indicates a controlled, much less volatile ride compared to the rest of the index. And sure enough, with a beta of 0.91, this fund is exactly 9% less sensitive to market swings. Couple that with a standard deviation of just 13.48%, which is notably lower than the category average of 15.55%, and you've got yourself a literal shock absorber. When we look at how these exact metrics help beginners assess long-term capital growth without losing sleep, these numbers prove the fund acts as a rock-solid foundation against daily market dips. Next up, let's look at alpha to measure the excess return an investment generates relative to its benchmark risk. The fund boasts a highly impressive alpha of 2.60. This is the mathematical proof that the managers are actively adding tangible value. It's a clear indicator that their specific stock selection and that barbell strategy are actually working to generate excess returns for the risk taken, totally outperforming passive strategies. Section 4, Comparing Peers and Benchmarks, the ultimate contrast. So, the core choice for conservative investors right now is pretty stark. Are you willing to passively take the full hit alongside the Nifty 100 TRI index? Broader large and mid-cap options, like the Nifty Large Mid-Cap benchmark, often expose you to severe drawdowns during volatility. But this actively managed pure large-cap fund aims to hit the brakes way before the edge, offering a clear, distinct advantage over other large and mid-cap options when it comes to capital preservation. The historical evidence here is super compelling. Trailing returns show the fund consistently edging out the Nifty 100 TRI and standing strong against the Nifty Large Mid-Cap benchmark over the 3, 5, and 10-year horizons. Looking at calendar year performance, out of its 17 years of existence, it has outperformed its benchmark and major peer funds almost every single year. It's been particularly dominant since 2021. But honestly, this advantage is most stark in weak markets. Check this out. Since 2010, the Nifty 100 has had 18 negative quarters. By outperforming the index in 13 of those 18 negative quarters, this fund basically defines downside protection. It means when everyone else is losing their shirts, this fund is losing significantly less. And naturally, that makes recovering and compounding a whole lot easier when the market turns back up. Finally, Section 5, Long-Term Wealth Planning, the Power of Compounding. This timeline right here proves their patience and perfectly illustrates why that unusually low 18% turnover ratio matters so much. They've held core anchors like HDFC Bank, Infosys, Cipla, and ITC for well over a decade. Moreover, 48 of their core portfolio stocks have been held for over 5 years. By completely ignoring short-term market noise, they allow the underlying businesses to actually grow and compound value for you, the investor. Historical multiplier data is a genuinely crucial tool to assist in your long-term wealth planning, mostly because it visualizes the actual, real-world yield of patience. Look at this. An initial 10,000 rupee investment made right at the fund's inception has compounded beautifully over the long term, growing to nearly 100,000 rupees. It practically 10x'd a modest initial sum into a substantial nest egg simply by staying the course. I want to leave you with this really powerful thought on market fluctuations from Value Research. It just perfectly encapsulates the mindset you need for wealth building. Abandoning compounding is the real risk. Volatility is an inconvenience. I absolutely love that. It shifts your entire perspective. The daily red and green arrows flashing on your screen are just inconveniences. Jumping out of the market and breaking that chain of compounding, that is where you actually lose your financial future. So as we wrap up this explainer, I want you to seriously ask yourself, will you let short-term volatility derail your long-term wealth? Does your current portfolio strategy truly reward patience and guard against the unexpected? Or are you just riding the index blindly? Thank you so much for joining me on this deep dive today. Keep learning, stay intensely focused on the long game, and I'll see you in the next explainer.